Global debt has surpassed $300 trillion. That is more than the entire global economy produces in a year. But the real danger is the hidden risk inside the system that supports it. In our interconnected global economy, a silent force has been building, shaping the destinies of nations, corporations, and individuals alike. This force is debt. On its surface, debt is a fundamental tool for progress, a way to fund innovation, build infrastructure, and smooth over economic shocks. But when it grows too large, too fast, it can become a source of profound instability. Today, governments, corporations, and households across the planet have borrowed unprecedented amounts of money, creating a financial landscape unlike any we have seen before. Over the past 2 decades, global debt expanded dramatically. This wasn't a gradual incline, it was a series of explosive surges. The era of ultra-low interest rates following the 2008 financial crisis made borrowing cheap, encouraging expansion. Then, the COVID-19 pandemic triggered a massive wave of government spending and central bank support to prevent economic collapse. Each crisis was met with more credit, and borrowing became the primary engine for growth. Historically, developed markets drove much of this increase, using their stable economies and reserve currencies to borrow heavily. But the dynamic is shifting. Emerging markets, hungry for capital to build their own economies, are now accelerating their borrowing at an even faster pace. By 2025, this relentless accumulation pushed global debt to a staggering record of $348 trillion. The increase in that year alone was the fastest since the peak of the pandemic, a clear sign that the world's addiction to credit was not waning. 3 economic giants, China, the United States, and Europe, led this surge. Each faced unique pressures that pushed their deficits, the gap between spending and income, to new heights, forcing them to issue more debt to cover the shortfall. This wasn't just a government problem. Households, firms, and governments all participated, stacking new layers of leverage, using borrowed money to amplify financial bets on top of their existing obligations. Bond markets became the critical channel for this borrowing. Think of a bond as a formal IOU. A government or corporation issues a bond to an investor, promising to pay it back with interest over a set period. This mechanism, repeated trillions of times, is the plumbing of the global debt system, and the demand for cash shows no signs of slowing. By 2026, governments and companies were projected to borrow a record $29 trillion in a single year, testing the market's capacity to absorb this unprecedented supply. To attract buyers in an uncertain environment, much of this new issuance shifted to shorter maturities, debt that needs to be repaid or refinanced in just a few years, rather than decades. This created what analysts call a maturity wall, a near-term future where a massive volume of debt comes due at once, raising refinancing risks. At the same time, the investor base was changing. Stable, long-term holders like central banks were stepping back, replaced by more price-sensitive investors like hedge funds, who are quicker to sell at the first sign of trouble. This made markets far more vulnerable to sudden shocks. Crucially, in many economies, debt grew much faster than economic output. This is a classic warning sign. It means a country is not generating enough new income to easily service its growing liabilities, a path that is unsustainable in the long run. For developing economies, the situation was even more precarious. High existing debt levels and limited access to affordable finance created a trap, constraining their ability to invest in climate adaptation, education, and health. In the corporate world, leverage also rose to new highs as firms pursued ambitious goals of scale and technological transformation. The race to dominate artificial intelligence, in particular, became a major financing event. Building the vast data centers and securing the specialized chips required for AI demanded billions in capital, concentrating immense borrowing needs within a handful of tech giants. As public debt burdens climbed, the fiscal space, a government's room to borrow more without jeopardizing its finances, began to narrow dangerously. With central banks now raising interest rates to fight inflation, the cost of servicing this mountain of debt began to climb, putting immense pressure back on government budgets. The numbers became stark. Analysts warned of U.S. interest costs soon exceeding $1 trillion annually, more than its defense budget. In Europe, concerns mounted over the ability of some nations to manage their looming refinancing strains. But a debt crisis does not emerge from numbers alone. It ignites in the moment that confidence is lost, when lenders suddenly question a borrower's ability or willingness to pay them back. The global financial system is now more leveraged and interconnected than ever before. The critical question is no longer if the debt exists, but why it keeps growing, and what happens when the bill finally comes due. Debt grows when economies slow and governments attempt to stimulate growth. Lower interest rates make borrowing easier. Corporations respond with new issuance to fund investment and operations. Governments expand deficits to support demand and stabilize employment. Households borrow more when credit is cheap and accessible. Central banks purchase assets to compress yields and support liquidity. Financial markets expand as lower rates lift valuations and risk appetite. Over time, the same amount of debt delivers less incremental growth. Higher leverage makes the economy more sensitive to interest rate movements. During shocks, private risks often migrate to public balance sheets. Demographics, productivity trends, and climate events add structural pressures. Shorter maturities increase the frequency of refinancing under uncertainty. A more price-sensitive investor base can amplify volatility. With narrowed fiscal space, future policy responses may be more limited. This is where the hidden risk begins to show. The real danger appears when debt grows faster than economic output, a critical tipping point for any economy. When the debt-to-GDP ratio consistently rises, it signals that an economy isn't generating enough new income to comfortably service its existing obligations. At this stage, the system becomes dependent on a constant flow of new borrowing, not for productive investment, but simply to pay back maturing debt. This creates a precarious cycle, often called a debt treadmill, where the economy must run faster just to stay in the same place. Consequently, rising debt service costs begin to crowd out other vital expenditures. For governments, this means less money for infrastructure, education, and healthcare. For corporations, it means reduced budgets for research, development, and expansion, stifling future growth. This relentless need to refinance creates what analysts call maturity walls, periods where a massive volume of debt comes due and must be rolled over. These walls concentrate risk, making the entire financial system vulnerable to the market conditions prevailing at that specific time. In such an environment, markets become dangerously reliant on easy liquidity conditions and low interest rates. The system functions smoothly only as long as the metaphorical taps of cheap money remain open, but this creates fragility. Even a small loss of confidence, perhaps triggered by an unexpected inflation report or a geopolitical event, can cause funding markets to seize up, triggering a much larger crisis. This is where the interconnectedness of the modern financial system becomes a liability. A problem in one corner of the market, like a struggling bank or a sovereign default, doesn't stay contained. Stress is rapidly transmitted across borders and asset classes through complex balance sheet linkages. The risk is often amplified by hidden leverage and complex financial instruments, which can obscure the true level of exposure within the system until a crisis hits. When market sentiment sours, falling asset prices erode the value of collateral backing these loans. This can trigger margin calls and forced deleveraging, where borrowers must sell assets into a falling market, creating a vicious downward spiral. Financial systems often behave linearly and predictably until, suddenly, they do not. The transition from stability to crisis can be abrupt and violent, a phenomenon known as a Minsky moment. Policymakers are often at a disadvantage. Their tools, like fiscal stimulus or interest rate changes, operate with significant lags, but financial markets react instantly, pricing in new realities in microseconds. As these dynamics played out, global risk monitors began flashing warnings, flagging mounting concerns around debt sustainability and the potential for a systemic event. The question was no longer if a shock would come, but when and whether the system was prepared for the speed at which its effects would travel. Because the global economy is interconnected, instability can ripple worldwide. Trade, currencies, and capital flows transmit stress across regions. Intermediaries adjust liquidity and risk quickly. Borrowing costs can rise suddenly for vulnerable issuers. Refinancing windows can close before maturities roll. Loss of confidence fuels a self-reinforcing cycle. Developing economies, already constrained, face sharper impacts. Tighter credit slows investment, hiring, and output. Policy must balance inflation, stability, and fiscal constraints. Shallow liquidity can amplify price gaps during stress. Credible backstops can restore order, but at a cost. Each cycle can leave more debt and lower potential growth. Debt sustainability becomes the central question for many sovereigns. Markets watch maturity profiles, growth, and credibility closely. History shows how these cycles evolve and turn. History shows that every major debt cycle eventually reaches a turning point. These inflection points are not sudden events, but the culmination of years of accumulated imbalances. They arrive when the cost of servicing debt becomes so burdensome that it forces a fundamental change in behavior from governments, corporations, and households alike. Often, an external shock acts as the catalyst, but the underlying vulnerability was built long before. The question is not whether the system will change, but how and when that change will happen. The path forward is not predetermined. It will be shaped by policy choices, market reactions, and the delicate interplay between global economic forces. We stand at a crossroads, facing several potential futures. One path is a gradual, orderly adjustment, characterized by stable growth and contained inflation. This soft landing is the ideal outcome, where economies manage to grow their way out of debt. Another path involves higher inflation, which erodes the real value of debt at the direct cost of purchasing power. This is a disorderly deleveraging, effectively a hidden tax on savers and bondholders that can lead to social and political instability. In some cases, where debt becomes mathematically unsustainable, restructuring becomes necessary. This can mean extending maturities, reducing interest rates, or even writing down principal, a painful but sometimes unavoidable step to restore balance. The most sustainable solution is raising productivity. Genuine innovation and efficiency gains improve the growth-to-debt dynamic, allowing an economy to service its obligations without resorting to inflation or default. Proactive risk management is therefore critical. This means carefully managing debt maturities to avoid refinancing walls, maintaining sufficient liquidity buffers, and establishing credible fiscal and monetary frameworks that anchor market confidence. Transparency helps reveal hidden vulnerabilities before they break the system. Understanding who owes what to whom and under what conditions is the first line of defense. In a deeply interconnected world, international coordination can contain spillovers when stress inevitably emerges, preventing a localized crisis from becoming a global contagion. But years of crisis fighting have left many governments with limited borrowing capacity. This lack of fiscal space could amplify future crises when the next shock arrives. To navigate this landscape, we must understand the scale, the speed, and the structure of debt to accurately gauge the risk. Watch interest costs, refinancing calendars, and growth trends closely. These are the vital signs of the global financial system. Ultimately, debt is a tool. It can build bridges and fund innovation, or it can fuel speculative bubbles and financial ruin. The risk is not in the tool itself, but in how it is used, and how its relentless compounding power is managed. This video is for education and information only. It is not financial advice. The future is uncertain, but understanding the forces at play is the first step toward navigating it. Stay informed. Subscribe for more macro insights. Global debt has surpassed $300 trillion. That's more debt than the entire global economy produces in a year. But the real danger isn't the size of the debt. It's the hidden risk inside the system that supports it. Governments, corporations, and households around the world have borrowed unprecedented amounts of money. Debt grows when economies slow and governments attempt to stimulate growth. Lower interest rates make borrowing easier, encouraging both governments and corporations to take on more debt. The real danger appears when debt grows faster than economic output. When this happens, the system begins to depend on continuous borrowing just to sustain itself. Because the global economy is interconnected, financial instability in one region can ripple across markets worldwide. That is why rising global debt represents one of the biggest macroeconomic risks of the modern era.